Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke. Together we're here to guide you through the maze of investing and give you insights that impact your portfolio.
Whether you're a seasoned veteran or just getting started, we've got you covered. The latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and anytime on our InvestTalk listener line. Just call 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So, why join us? To get ahead in your investment journey with strategies, tips, and knowledge that can unlock the full potential of your hard-earned money.
But first, hit subscribe, turn your notifications on, and let's start making informed investment decisions together.
Welcome to InvestTalk.
This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, May 1st, 2024 edition of InvestTalk. And yeah, that means we are a third of the way through the year. Can you believe that? 1/3 of the year is already behind us. And today was an exciting day in markets. It was Fed Day. We had a Fed announcement. We had a Treasury refunding announcement. And there was a lot to take from the news today. And we'll dig into that here in a little bit. But I want to remind you that this show is about you. That's why we do this show, in order to field your finance and investment questions, understand your concerns, understand the questions that come to mind on a daily basis, whether that's about an individual company, a broad sector, a personal finance topic, whatever is on your mind. We encourage you to reach out with those questions so that you drive the show. We have topics that we will discuss, but ultimately this show, once again, is all about you and helping guide you through the maze of variables that play into market moves, both short-term and, most importantly, long-term. And that's what we are here to accomplish each and every weekday. Now, with that said, we're going to get to the market performance in a bit, as well as run down show topics, but we're going to hit our first caller question now as usual.
Hi, Justin, Luke, and Steve. I'm calling in a question regarding the stock Target, TGT. I was looking to get your opinion on what you thought and what would be a good entry point. Thanks. I really enjoy your show, and I'll be listening for the answer.
All right, looking at Target, it's the nation's 6th largest retailer and one of the few big box retailers that has the scale to compete with the likes of Walmart and potentially Amazon. They do have, a pretty good online presence, but their earnings have been coming down, and the stock prices has been coming down since late 2021. And mainly because during the pandemic, 2020 and 2021, people were buying a lot of physical goods because they have a lot of extra money laying around. Now that has shifted, and earnings hit a peak around $13.56 in 2022. But this year, they're supposed to only make $8. Sorry, excuse me. That was fiscal year 2022. They have a different fiscal year. I don't know if you know this, but not every company has a fiscal year that goes January to December. Okay. Sometimes their fiscal year for 2024, for example, can start, months into 2023. Okay, so that's what's happening with Target. But for fiscal year 2025, expect to make $9.40, and it's about $156 per share right now. So you're talking about a mid-teens multiple, about 16 times forward-looking earnings. But it did rally from its lows back in November of last year, around $100 per share, and then it recently peaked at about $180 per share. Now at $156. Its all-time high was up around $270. Okay, so it's in obviously a downtrend. It's starting to roll over again, so the technicals are certainly meh, at least in the near term. But Target is a very good business. You can't really argue with that. If you look at its return on invested capital, about 15%, return on equity, 34%. Its 5-year average median is 31% on return on equity. That is a quality business. So you're looking in the right space. They have minimal debt, only about 14 billion in long-term net debt on a $72 billion market cap. That's fine. Times interest earned is about 12. So you're fine there. So I like what you're looking at. I just don't like the recent trends. It does look like it is rolling over, but I'll give you a support level. 133 would be amazing. I think that would be a great place to pick up target. I would be watching for that. My first position, though, my position would probably be down around 142. So between 133, 142 in that range, I think that's a good buy zone for target. I like the company. I like its scale. I just don't like the near-term earnings trends as well as the chart. So be patient on it. Thanks for the call. Now, we have a lot of ground to cover over the next 45 minutes or so. Our main focus point is around the business of healthcare. Walmart is shutting down parts of their healthcare initiatives, and we're going to dig into this because this tells us a lot about telehealth and these companies that are getting into the healthcare space when it's not their core competency. And it seems a lot of companies are struggling with this, and we're going to dig into that story. In addition, we're going to talk about the recent opening of the first new nuclear power plant since 2000. When was it? I have it here. 2016. And before that, it was 1996. Okay. So there haven't been a lot of nuclear power plants opened in this country over the last 30 years. That could be changing. So we're going to talk about some trends in that industry. Also, there's a new potential measurement for America's well-being. Most people will say that the GDP number that you see from government sources, as well as what's discussed in finance media, we know there's some disconnect there. And so the question is, how do we better measure America's well-being in other ways besides what the GDP is looking like, what stocks are looking like, etc.? So I want to dig into that story. And then lastly, working from home. Well, it seems that it's not as efficient as we had once hoped. So we're going to look at the studies coming out of places like Harvard and the Bank of New York, or Federal Reserve Bank of New York, excuse me. So that's what we're going to discuss today. We're also going to get to your voice bank questions. One is on the S&P portfolio, Spider's portfolio, S&P 500 ETF, SPLG, 401k funds we'll get to, as well as your questions that come from our InvestTalk YouTube channel. And of course, your live calls. We welcome your finance and investment questions right now at 888-99-CHART. And we're going to go into a short break. On the other side, we'll talk about today's market activity, the Fed announcement. But remember, you can call anytime and leave your question on the InvestTalk voice bank. And if you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART. The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors. Now let's take a look at the market today after the Fed announcements. Today was Fed Day, and it was also Treasury refunding announcement, the second part of that. And the Treasury funding announcement was relatively hawkish. The expectations for issuance of longer dated securities was higher than expected, and that will be a bit of a drain on liquidity. But when you look at the Fed announcement, it's pretty clear. This is the start of the easing process. Yes, they teased a rate cut process throughout 2024. That was back in the fall, and the markets rallied on that, and rates came back, from about 5% of the 10-year down to about 4%, and that was a big help to asset prices, especially as we close the year and into through the first quarter. And part of the pullback recently has been, hey, higher for longer. The Fed is not going to be quick to cut rates. And you've seen the 10-year creep back up, approaching that 5% level. Now, the Fed didn't cut rates today, nor did they really give a strong indication of when they will cut rates. But what they did do was start the process of unwinding QT. June 1st, they will drop their QT, meaning their balance sheet runoff, from $60 billion per month to $25 billion per month. That's a pretty big move, right? Over 50%. And frankly, that's easing. That is easing. If QT is tightening policy, shrinking the balance sheet, then slowing that process is absolutely a pivot. So this is the start. Even though it's not lowering rates, it is the start of the easing process. And on top of that, they announced a Treasury refunding facility. Now, it's not big. I think it's just the start and testing the process and things like that. But they're going out there and using some of their balance sheet capacity, like the Treasury General account, to go out and buy back treasuries, maybe some that are under par, for example, and in effect, trading, being able to, sell things, sell issues at par, 100, and maybe interest rates rise, they go down in value, they can go buy back those bonds at a gain effectively, right? Selling them at 100 and buying them back lower. Corporations do this. They can buy that back their bonds when they're maybe the business is down on its luck. So I think this is it's minor right now. It's not a big number. It's only a handful of issues, and I think only $2 billion per issue. But it's the start of the process, and it looks like this could grow. So those are the three big announcements today. And initially on the Fed press conference, shall we say, the market rallied, especially after Jerome Powell said, hey, the next move in rates is likely to still be lower. Probably not going to be increasing rates. The market liked that. But the last half hour, the market sold off and closed near the lows of the day. And there's an old saying in trading and markets, it's not how you open them, it's not how it trades throughout the day, but it's how you close them, how the market closes. And the market closed certainly weak. And this tells me that we are in the midst of that, I call it an ABC leg. So corrective periods often follow a similar pattern. You have the initial drop, the breaking of the uptrend. That was basically the entire month of April. We pulled back in the S&P to support right around the 100-day moving average and what we call the 5-2 retrace. So the first major support, fib support. And we got a little bit of a bounce, and now we're rolling over once again. So that bounce was the B leg, and now it looks like we're commencing on the C leg. And the C leg looks like the next major support will be 4,800. Now, it could go as low as 4,600, and you still have the broader uptrend intact. But 4,800 is the logical next place for the market to go, and that would be major support. It would also be the high from 2022, January of 2022. And oftentimes when you get a breakout above levels like that, you get a retrace and a retest of that level. And so that's likely what you will see over the next 4 to 6 weeks or so. So that was the market today. Interesting Fed day. This is the start of the easing process, even though they didn't lower rates, and they may not lower rates. It could just be all about the Fed balance sheet. And don't be surprised if that is the case. Now we're heading to a short break. Tom in Kentucky, hang on. You are next on InvestTalk. But if you are not Jack and you want to, or sorry, you are not Tom, feel free to give us a call at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast. Let's go to Kentucky and talk with Tom. He's looking at Jack in the Box. Do you own it or looking to buy it?
No, it's just on my watch list, and I saw it's down a lot for the year, and it looks like it's down even today. So I was just wanting to see what you thought about it, Justin.
Yeah, it is approaching the lowest level, since 2020, since the COVID crisis. It did very well coming out of the COVID crisis, hit a high of over $120 per share. Now we're at 55 and change. And their business, frankly, hasn't really deteriorated much. It's pretty steady. It's a fast food chain. I don't know if maybe not everybody knows Jack in the Box. I know there's plenty here in California. They operate 2,186 Jack in the Box restaurants in 27 states and Guam. 3.2% dividend yield, but earnings are struggling. Earnings last quarter were down 3%. Revenues down 8%. And the market isn't expecting a rebound anytime soon. So the question is, why try to catch this falling knife? This is in a clear downtrend, right? It pivoted back in last summer at about $100 per share, and it's down nearly 50% in less than a year. So I'm not sure what you're seeing here that makes this that attractive. What do you think makes this such an attractive time to buy it?
I just had it on my watch list forever, and I just saw the drop, and I was like, it's still paying the dividend, and it said it had enough cash flow to keep paying the dividend. And I just wanted to see what your opinion was.
Yeah, I mean, it definitely does. The issue is the amount of debt it has on its balance sheet. Now, the good thing is most of that debt is termed out to 2034. 2034 is when the most of their debt matures. Now, they do have some maturity in 2027. So that's about $533 million. Not a small amount, to be honest with you. So I just don't love the trends here, both in the equity, both in earnings, as well as cash flow. I wouldn't really have it on my watch list. I think there's much better uses of your capital than Jack in the Box.
Thanks, Justin.
No problem. Thanks for the call. Now, our focus point today is about the business of healthcare. And Walmart on Tuesday said it will close all of its healthcare clinics across the country. And it would also end its telehealth or shutter its telehealth provider, which it acquired just a couple of years ago in 2021. Now, it was a private transaction. Nobody knows how much they paid, but that was a lost cause. And they will close 51 clinics across Arkansas, Florida, Georgia, Illinois, and Texas. Now, this won't affect their pharmacies or their vision centers, so don't worry about that. If your local Walmart has those won't shut down. And they're highlighting a couple of factors. The main one is a shortage of quality healthcare workers. It's increasing their labor costs. And so it's making their ability to provide low-cost services much more difficult. And this comes just a month after Walmart planned to double the size of its clinic footprint. So this is a quick about face. And what they were trying to do is upend an expensive, complicated, and entrenched medical system. And offering services for $30, $45, $25, teeth cleaning was $25. And this is on top of other companies that are trying to do the same thing and struggling. CVS is one. They had poor earnings today. Walgreens Boots Alliance, same thing. And Amazon paid $3.9 billion for One Medical. And they're having trouble kind of getting traction there as well. And so what it shows you is that just because a company goes into a particular space does not mean they have the core competencies to actually make that happen. Even when they make acquisitions like Walmart did with a telehealth provider. Didn't solve the problem of bad economics, low demand, and the lack of IP to support those endeavors. And the IP isn't always in just brands, but it's also know-how and leadership. When you've done something for years on end, you know kind of the pitfalls, you know the problems that can arise. When you try to launch a business outside of your core competency, which Walmart is obviously, their core competency is retail. And sometimes a small offshoot like groceries can work, and they've been doing well at groceries. But when you go the completely other direction with healthcare, it's clear that's very difficult to conquer, especially in an environment like this where it's a very labor-intensive business. And to get those workers and pay those workers the requisite amount is just very difficult. And so while healthcare, it sounds great, it sounds interesting as an investment, both by buying different companies and companies you might own and expanding into that field, it's a difficult area to get into and invest in. And this shows the way. Now, in the next InvestTalk, we'll look into this question. Is it easier than ever to fund investors to build a good portfolio? Compared to the 1980s, investors who don't want to build their own portfolios have much better options today. That story tomorrow, but for now, I'm Justin Klein, and we are ready to take your calls at 888-99-CHART. Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke, and together we're your guides through the maze of investing. We'll bring you insights that will impact your portfolio.
Whether you're a seasoned investor or just getting started, we've got you covered with the latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and on our anytime listener line at 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So why join us? To get ahead in your investment journey with strategies, tips, and knowledge that will help unlock the full potential of your hard-earned money.
But first, hit subscribe and turn your notifications on, and let's make informed investment decisions together.
Welcome to InvestTalk.
Hi, Justin and Luke. A long-time listener to the show from Minnesota. I have a question for you gentlemen, please. I'm wondering what you think of the fund SPLG. It seems like it's a well-diversified fund with very low maintenance costs, I guess. I'm considering getting rid of all the holdings I have in VTI. One, the sector is very overweighted in everything. It has, 6,000, 7,000 stocks in it. I'm sure you guys know. And I'm considering putting some in the ETF I just told you about, and also in the Berkshire Hathaway fund for getting value stocks, and then also possibly in a mid-cap fund to get my mid-cap exposure. So I'm considering doing that and getting rid of the VTI. Would this be a good move, do you feel? Thank you for your thoughts on this. I appreciate it. Best wishes to Steve. Hope he's getting better.
All right, looking at moving from VTI into SPLG, which is this just an S&P 500 fund. And the simple answer there is no. You are getting less diverse, and you are actually getting worse exposure to the more important sectors. Now, is it a huge difference? No, you're still drastically overweight technology in both VTI and SPLG. Neither one of those, I think, are great allocations in this environment because of mid to low single digit exposure to basic materials and energy, and only high single digit exposure to industrials, the three best sectors to really be in right now. So you're kind of, they're once again, they're not that much different. And so there's not much of a change there, but I would rather have VTI over SPLG. Now, when it comes to mid cap or the Berkshire is kind of a mini value fund with a lot of tilt towards industrials and financials because of Geico and because of Burlington Northern and all the industrial names they have under the umbrella of Berkshire Hathaway, and that's good. And that's like I said, like a mini value fund, and some exposure there is good. And then if you go to a mid cap funds tend to, I just use MDY as a good proxy for that's the S&P Mid Cap 400 ETF. That was the best mid cap fund out there. I'm not saying it is, but it's a good proxy just for the mid-cap space as a whole. And if you dig into that particular fund category, you'll see that 21% of MDY is in industrials, and about 6% is in energy versus only 4% in VTI or SPY. Basic materials is at 6% versus only about 2% in the S&P 500. So there's some improvement there, but it's, once again, not an end-all, be-all. So if you are talking about trading out of VTI, I would say no for SPLG or SPY, and I would say yes for Berkshire Hathaway or some sort of mid-cap exposure. Thanks for the call. Now, I hope you've been telling your friends that the InvestTalk audio podcast is also available in video form over on our YouTube channel. And every day we get questions in the comment section of our YouTube channel, and we try to get to one or two of those each and every show. Now, Bianca Smith says, I'm thinking about adding the Invesco Building Construction ETF, ticker PKB, to my Roth IRA for a mid to long-term hold. I believe there's a potential for future growth in the building, industrial, and material sector, but with the recent decline in housing permits and starts, I'm wondering if now is the right time to invest in PKB. Should I wait for further pullback, or would you recommend dollar cost averaging in? Now, my typical answer to that last part is dollar cost averaging makes sense because it's always hard to find that exact bottom, but you always want to do that in the right fund. Now, first off, let's look at PKB. It's the Invesco Builder and Construction ETF. It has an expense ratio of 62 basis points, which frankly, that's on the high side of the fee you're going to pay on a sector ETF. And that's effectively what this is. And it's a fairly concentrated sector ETF. Because if you look at exposure here, let me look at the top 10 holdings. Carlisle Companies, Martin and Marietta Materials. That's a material name that goes into homes. Pulte Group, one of the largest home builders out there. Vulcan Materials, Lennar, D.R. Horton. Home Depot's in there. So what you're seeing is a mix of a lot of material names that sell into the home building market and then home builders. And so it's going to be highly correlated with things like the ITB housing market, but a bit more diversified because it has the Home Depot in there. Now, from a sector perspective, this is 33% industrials, 45% consumer cyclical. Those would be mainly the home builders, and then basic materials at 18%. Now, if you compare that to like an XLI, that's only a 9 basis point expense ratio. It's all industrials, giving you a much broader exposure to the industrial space. So I kind of like that a bit better, frankly. Now, I don't mind a little bit of this because I do think home builders are going to do relatively well. We've been under building homes for many years. And despite high interest rates, the housing market, especially in the new home market, continues to be relatively robust. So having a little bit of this is fine. I would rather have a little bit more XLI, to be honest with you, if I'm getting both. But this could add a bit of a diversity to an industrial exposure in your portfolio. So I'm okay with it in small doses, and dollar cost averaging would be the best way to get in. Thanks for the call. Now let's talk a little bit about nuclear power. And a new nuclear reactor reached commercial operation in Georgia on Monday, just recently. And this is one of the first reactors, or just a handful of reactors that have been built over the last 30 plus years. And this is adding to 2 reactors that are already in operation at Plant Vogtle, VOGTLE. So is the G silent? I'm going to go Vogtle. And this is operated by Southern Company. SO is the symbol. And it cost them more than $30 billion. That was twice its initial estimate. Now, this is now the largest nuclear plant in the country and the largest generator of carbon-free electricity. And this comes on the heels of the public perception around nuclear certainly shifting. The issue, though, within the industry, as always, soaring costs, delays. And this is an example of that. The other most recent nuclear power reactors in the U.S. were completed in 2016 and 1996 by the Tennessee Valley Authority. But utilities across the country are starting to include proposals for next generation reactors, also called small modular reactors, SMRs. And this could solve a lot of the cost overruns, because what they are basically built in a factory, a large factory. And they're still large, but a lot smaller than your traditional reactor. And that creates economies of scale, being able to build a lot of small ones, put them in place, then bring the fuel in, right? And start them up. And the U.S. plans to attempt for the first time to bring closed nuclear power plants back online as well. The Energy Department is offering $1.5 billion for a loan guarantee to finance the restart of an 800 megawatt reactor in Michigan that closed just 2 years ago. And the big question is, can the lessons from the actual large reactors that have been built, especially this recent one, be applied for new ones? And I think the simple answer is yes, but they have to do it now, as those lessons are fresh in the minds of those that build it. Now, federal tax credits are now available to nuclear power producers that could really alter the outlook of the entire industry. This is part of the Inflation Reduction Act. And it puts the tax credits on par with things like wind projects. So there are already companies like Duke Energy, as well as Southern Company and the Tennessee Valley Authority, that are considering small modular reactors. You already see many of those being deployed in China and Russia. And the first North American SMR is likely to be delivered in Canada. So maybe we can learn a thing or two from our northern neighbors and get those moving. But it's pretty clear that the sentiment shift in the industry is here. It's just a matter of how does the money flow to these projects. Is it from corporations, the utility companies, or is it with the help of government? And like most big projects like this, it's typically a partnership between public and private. So I could see more of this happening, and it's definitely a good space to continue to allocate capital towards. Now let's grab another voice bank question from 888-99-CHART.
Hey guys, I just left my company that I was with for about 4 years. I had a Roth 401k with them that I received a match on. Now that I left, I'm just wondering, what do you recommend I do with those funds? Would you leave them in that company's program, or would you do a rollover? Just curious, get you guys' thoughts. Thanks.
Very simple. Roll it into an IRA. Now, you might have some of that 401k be traditional 401k, others might be a Roth 401k. And so that means you probably are going to open up both a traditional IRA and a Roth IRA and roll the traditional 401k into the traditional IRA, and same with the Roth 401k into the Roth IRA. It's that simple. What that does is open you up to invest in anything, as opposed to sitting in that old 401k, and you're going to be limited to 15, 20, 25 funds that are made available to you. And on top of that, you're paying annual fees along with all the other providers or other, employees within the plan to keep that 401k running. Whereas you have a IRA, no cost there. You just roll it over into those IRAs. So I'd encourage you, open those at a large brokerage firm. We use Schwab, but you could use Fidelity, you could use E-Trade, but something that is large and respectable. So go with one of those as well. Now here's another question from our InvestTalk YouTube channel. Mike Garudo says, what are your thoughts on WERN, WERN, Werner Enterprises? My cost basis is 41. Should I cut my losses or keep buying? Now, Werner did have earnings, it looks like either after the bell yesterday or this morning, I'm not sure, but the markets certainly moved a lot, and it was up nicely, up nearly $1 today, a $35 stock, so up nearly 3% on the day, on a decidedly red day for markets as a whole. But this is still near a 52-week low, and that's my worry, is why is the relative strength so poor? It's 17. And if you look at many other trucking companies within this industry, they're doing a lot better. And so, is it a bad company? No, it's fine. It's profitable. It doesn't have really too much debt on its balance sheet. Yeah, as a fairly good balance sheet, but its free cash flow is negative. And if you look at its profitability, return on equity is only 7%, return on invested capital only 5%. Its 5-year average for return on equity is 15%. So, your bet here would that be that it moves back to its longer term profitability metrics, but it worries me that it now has mid-single digit profitability. And so, it's a logistics company, but it's not the best in the industry. And that's what we like. We like to buy the best in the industry, best of breed. And while Werner is a fine business, it's an okay business, it certainly is not best of breed, especially right now. So I would be looking for others within this industry. Thanks for the comment over on our YouTube channel. Now let's talk about the economy and how it is doing. And I think it's pretty clear from most people, and especially the polls, that what's happening with GDP growth, growing 13 in the last 15 quarters with unemployment rate at 3.8%, it's pretty clear that most people don't agree with the assessment that the economy is doing well despite those numbers. And obviously, numerous factors impact the feeling about the overall economy, especially your political leanings. If your party or you approve of who's in the White House, you tend to be happier with the economy and vice versa. But, the GDP figure was invented back in 1934. And even the inventor, Simon Kuznets, acknowledges that the welfare of a nation can scarcely be inferred from a measurement of national income. So even he said, this is a good measure of economic activity, but is it a good measure of economic wellness or wellness of the country as a whole? And it's pretty clear that has diverged. Now there's a new called the Commission of Reimagining Our Economy, Corp, and they have a goal to shift the focus on how the economy is doing to how Americans are doing. And they have a multi-part measurement system. And it's pretty interesting. And it's rooted in a county level measurement. So it's not just looking at an aggregate. It's saying, okay, based on where you're living, your race, ethnicity, age, education, income, sex, etc. And it breaks down into economic security, economic opportunity, health, and political voice. So political voice is like, how much are your views being reflected in ultimate policy in Washington? And the reality is, typically isn't. And so most places in the country score poorly in political voice. Health, it's actually improved in recent years because of more coverage. So go look this up and follow it. The core score, it'll definitely give you a better sense of whether or not the country is doing better or worse. GDP is not a good way to go. Now we're heading into our final break. So Bill, hang on. You are next, but give us a call at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
We're here to answer your finance investment questions. So make sure you give us a call at 888-99-CHART.
Let's go talk to Bill in Northern California. He wants to look at Starbucks. Down big on earnings. You're probably wondering, is now the time to buy, right?
Well, yeah, actually I was going to trade stocks and ask you about Equinix, EQIX, but I did buy some Starbucks. I had a good to cancel order that hit at 75 something. So I did buy a little bit. I didn't own any until today, so yeah, I am pretty curious about that.
Yeah, well, they had rough earnings. They missed on revenues by 6%, and revenues year over year were down 1.8%. The real problem here is China. China revenue was down 11%. And, I think this is just another shot across the bow of the broader economy. We've continued to see, well, the broader economy is relatively strong, but, it's weakening from the bottom up. And we see that with the dollar stores struggling. But now you're starting to see earnings out of places like McDonald's as well as Starbucks that, kind of the lower middle class, the middle class, they're starting to cut back on their spending as well. And, I think domestic revenue was down 3% North America. To me, though, I like to look at this through the lens of what's the quality of the business. Near term, there's definitely some headwinds. And technically, it probably has more downside. I would say till 64 is that major support level, 64, 65 range. So another $10 from here would not shock me to get down there. But I kind of like it at those levels between 50 and 65. That's kind of that range where, from a technical perspective, there's a good amount of support. And from a valuation perspective, would be more in line, right? Yeah, enterprise value EBITDA is now down to about 15, which historically for Starbucks is on the low end. So we're getting there. We're definitely getting there. Could easily see a bit more downside, but much better than that 125 level that I was trading at back in 2021.
I just wanted to get my toe wet on it and then see what happened because I don't own any shares. And I thought if I get in and I have it in my stock list in my my account, then I'll follow it more closely than if I don't. So that's kind of my strategy. But I was thinking maybe too, like you said, another $5 or $7 downside. So
yeah,
thanks for putting that in perspective.
Yeah, I actually did on this earnings announcement. I believe I did this. Was it today or was it yesterday? Yeah, it was today because the market was down, or because it was down. I sold a 70 strike put that expires this month. I think I got 70 cents or something like that. But those are the things that I like to do. Is sell a put. I rather buy it at 70. I'm going to get paid. If it doesn't go down there, or maybe I get put it, and it's going to cost me effectively $69. And then I could sell another put right down at maybe 67.50 or 65 strike. And I'd love to pick it up in that area as well. And so that's another way to play this as well. So I like this area to start accumulating Starbucks. I wouldn't get super aggressive because I do think there is potentially more downside near term, but great business, obviously. Thanks for the call. And frankly, this is a lesson. I think I like it when I see great brands like Starbucks that historically have high profit margins. They fall in rough times. You know, it's down $50 from its all-time high, right? Down nearly, I'd call it roughly 40%. But that's an opportunity. You should be excited about this. Its return on invested capital is 63%. Now that's higher than its long-term average, which would be closer to the mid-30s. But even the mid-30s is an amazing business. So Starbucks is starting to give you some opportunity. And once again, it's not a screaming buy, but it's within the zone. It's saying, okay, this is a reasonable valuation that I will pay for a great business. And, you know, this is where you maybe start stepping your toe in just a little bit. You don't have to do it all at once. It's not an all or nothing thing. It could be one step at a time. I'm Justin Klein. This week's another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember, tell your friends that the InvestTalk podcast is now available in video form over on our YouTube channel. Just search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.